It's 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Shauna Smith alongside Diane King Hall. Here are three things that you need to know this morning. Stocks head for their biggest weekly decline in months as the so-called FOMO rally fights a big test from the Fed. Chair Jay Powell says that rates will climb higher, denting appetite for a seemingly unstoppable melt-up. The Nasdaq fought back to close higher on Thursday, but still faces its worst week since April. There could be more pain for stocks ahead, says JP Morgan, but this time from the threat of an unknown unknown. And concerned central banks will hike the global economy into a recession is lifting appetite for the relative safety of bonds, both in the U.S. and across the Atlantic. Weak German services data has ignited concerns over an economy already in recession, with bond yields falling and treasuries following suit. Now, Janet Yellen saying that there's a diminishing chance of a stateside recession. However, the Treasury Secretary told Bloomberg that it's still a risk amid the Fed's hiking campaign. And Bitcoin's big week. The world's top digital asset broke through the key $30,000 level for the first time since April and has held ground around that mark despite 2 days of testimony from Jay Powell. It comes as a number of traditional finance players like BlackRock and Fidelity push further into the space. The move is even more notable considering a recent aggressive regulatory crackdown by the SEC against major exchanges, Binance and Coinbase.
Now, the FOMO rally glitches. Stock futures tick lower as investors expect more interest rate hikes ahead from the Federal Reserve. Chair Jerome Powell reiterated to lawmakers on Thursday that the central bank expects to raise rates one or two more times this year, but at a slower pace to avoid tipping the economy into recession. Will the market downturn continue, and are investors pricing in more tightening? Let's bring in Simeon Hyman, ProShares Global Investment Strategist, and Cole Smead of Smead Capital Management, CEO, on this conversation. Simeon, we're going to start with this question to you. The downdraft, the FOMO rally faced a headwind this week. Is this a temporary bump in the road in your view?
Well, I think Powell has come to save the market, notwithstanding the 7 names that people are talking about, but I think he's come to save the other 493. Because if you look at what's happened over the last couple of quarters to the S&P 493, let's call it, there's been a decline in earnings and a shrinking of margin that's primarily driven by inflation. And it looks like he's getting the job done at this point. Break-even inflation just 1 year out is 1.8%. Will a couple of more hikes on the short end make people a little nervous? But we've got to get back to that 2% inflation so that companies can start to make real earnings growth again.
Cole, do you think the Fed should be done raising rates at this point? Simeon just mentioned that 2% inflation target. We're still more than double that at the current level here. Is the fight for the Fed over just in terms of raising rates? And I guess, what do you see as that policy going forward?
Yeah, well, I think to follow on what Simeon said, I think where I would disagree is using the market to understand where we're going has been a terrible guide for 2 years. So those same futures curves you just mentioned, they were what the fool followed. And the fool looked and said, this is transitory, and obviously missed inflation altogether, as the Fed did, might I add. So I think it's a very untenable position that the Fed sits in, just so we're all on the same page. It sucks to be Jerome Powell, frankly. But the reality is it's going to be very tough to put a baby back into the womb. I mean, that's never happened with motherhood, and therefore it's probably never going to happen with this. And one thing I'll add, the Fed's out of model because we have the largest consumption age group in America. We call millennials. They are in the consuming age of their life. And that is not like anything of the last 20 years. It's really, you'd have to go back 30, 40 years to find something like that in a Fed model.
Cole, I want to follow that then and ask, so are you saying that the Fed needs to hold the line and not continue with this path of future rate hikes?
I'm saying the Fed's biggest trouble is they cannot derail the economy successfully right now. We've seen that they can impact asset markets. The bond market got crushed. I mean, we want to talk about the bear market that we saw in stocks. The bond market got destroyed. So we know they can affect asset markets. But right now, I mean, go look at low-end wages. The third and fourth quartile of wages in America are doing the best. They're outpunching inflation. They're seeing real wage gains. How bad can the economy be when the poorest people in society are winning so much?
So, Simeon, how should investors then be looking at this, just given the fact that there's so much uncertainty out there, there's so much unknown in terms of what the Fed's next move is going to be, and then not only that, but also how the market is going to interpret anything that comes out of the Fed's mouth?
Sure. Well, the stability that we've seen, if we don't want to look at the stock market, we look at the bond market. And what we see is stability at the longer end of the curve. The 10 years barely budged, rallied to about 3.5%. It was at 4%. Now it's at 3.75. That means that earnings multiples, PE multiples, are likely to be static, but it does mean that everything's about earnings. And earnings have been shrinking. But there is a place in the market where earnings have been growing. We focus on the S&P 500 Dividend Aristocrats. It's our ETF ticker NOBL. Those are companies that consistently grow their dividends over time, and they have pricing power. And while the S&P 500 has been shrinking earnings, those companies has been growing them. So you have to find growth in the marketplace, even while there's a sort of little bit of a long tail for inflation, even if it's just another year or so.
And speaking of just the tail of inflation, with inflation expectations where they are now, where are you expecting us to land economically?
Well, the good news is that if break-even inflations have come down, but at least up to the 2-year, we have higher Treasury rates. That means that real interest rates are pretty high right now, in fact, higher than they usually are. That's going to be contractionary. So that should definitely put some brakes on the economy. Cross fingers. It looks to us, what's the difference between stagflation light and a soft landing? We're going to be likely somewhere between +1% and -1 on GDP. So somewhere in that meh economic environment.
Well, where do you think we'll be by the end of the year when it comes to equities? We've seen a number of the banks, Goldman being one of them, Bank of America, RBC, just to name a few, that have actually raised their year-end targets for the S&P in the last week or so. Do you think we're headed much higher from these current levels?
Yeah, the idea that we're going to end the low rate regime with a cute little bear market that is garden variety and adorable, it's just not going to happen. We're probably going to see a nasty bear market by the end of this roiling, because I mean, if you can get 5.25% or 5.5 or 5.75 at some point later this year, risk-free, how unattractive do a lot of things out there look? And I'm not talking about just stocks. So I really think that's the problem, is the opportunity cost now haunts investors. It doesn't help them. And the reality is, there are narrow places in the market where you can go make really good money. Energy is great. It's just, to Simeon's point earlier, it's smaller than Apple. So the question is, will the 7 names that he mentioned destroy the market by year end, or will the other 493 some way be able to allay that problem? And we just don't see that happening. We think pain has got to finish nasty euphorias like we saw with SPACs and IPOs and the Reddit crowd.
All right, Cole and Simeon, stay with us, because corporate profits have retracted for 2 quarters in a row, and analysts are forecasting the same for Q2. Now, according to FactSet, analysts expect a 6.4% earnings decline for the S&P 500 in the second quarter. If this happens, it will be the largest drop that we've seen since 2020. If an economic recession follows this earnings recession, where should investors be putting their money? We want to bring back in Simeon Hyman, ProShares Global Investment Strategist, and Cole Smead, Smead Capital Management CEO. Cole, let me start with you on this one, with earnings profits here contracting 2 straight quarters. In terms of how investors should be reading this, how they should be preparing for the second half of the year, what do you think?
Yeah, I mean, I think businesses are dealing with like a vastly different environment. I just mentioned labor costs just a second ago. That is coming at them. Interest costs are coming at them. Those are hurting corporate earnings, no question about it. And you have to remember, we're coming off the highest corporate profits as a percent of GDP we've ever had in U.S. history. So it is not shocking to see a contraction in margins in the aggregate, and that therefore it's going to affect earnings. Now the question again is, will people pay the same multiple for lower earnings? We will see.
Simeon, that's a good question, actually. Will people pay the same for lower earnings? I mean, are you expecting, first of all, to see lower profits in this quarter ahead, or weaker revenue growth? What are your expectations?
Well, they'll pay the same for lower earnings, but then, of course, if earnings did shrink 5%, then the market's down 5%. So, and that's, I think, in sort of the ballpark of where we think things may end up in the near term. One bright spot is that sometimes you colloquially hear people say, well, there's so much leverage in the system. Actually, net debt to EBITDA, which is the classic measure of leverage, is at all-time lows for the S&P 500, which again points to the meh. But I come back to those dividend growers. You have to find somebody who's going to grow earnings. And here's the interesting thing. If you look at those consensus estimates, the consensus estimates are for actually more of an earnings decline for the dividend growers who've actually been showing up with margin expansion in this environment. So they're a little cheap and expectations are a little low. There are other ways to get there. That's our favorite. But you got to find some folks who are going to be able to fend off this margin contraction.
And who are some of those dividend growers?
You got some classic names. You've got Coke, you've got Procter & Gamble, and then you have, some other names that might surprise you like Nordstrom, but they are the folks who've been weathering economic storms for 25, 30, or 40, or 50 years.
Cool. What about outside of U.S. equities when it comes to the underperformance that we've seen recently in international plays? Are you seeing any opportunity there?
Yeah, I mean, think of the tumult we saw here in the banking sector. That was a U.S. problem. People have asked us, why was it such a U.S. problem? Well, because we had a euphoria here. We were the center point of that. And therefore, a lot of stupid things went on in banking, too. If you look at Europe, who was really the basket case of banking of the last 20 years, there was no issues at all. It's merely a flesh wound, to quote the Monty Python. So the reality is that the European banks come out of this being the whipping boy, very cheap, and yet at the same time, the return on equity is climbing because even the ECB is being hawkish, even the BOE is being hawkish, and therefore their net interest margins are growing. And so we see it as not to say that the U.S. banks you can't make money in regional banking. We've been doing a lot of work in that space. But I just pointed out because it's just where no one wanted to be, and therefore there was just far less risk. I think that's a very good guide for people as they go forward. What were the former darlings? How long does it take them to get their souls crushed before people give up? And therefore you should go sniffing around. The same thing happened in energy a little over 2 years ago.
Simeon, I want to ask you, so this week we saw a little bit of a risk-off play, but it wasn't completely risk-off. You saw some conversion into the bond market. What are you advising clients right now? Is it a cool your heels? How are you advising them on asset allocation?
Well, I do think that there's an opportunity to go places you may haven't gone in a while. And we would suggest a little bit of a preference, perhaps not to additional diversification outside the U.S., but within the U.S. Mid and small cap stocks have been entirely left behind for over a decade. They're trading at 50 cents on the dollar on a price to book basis. If you were out of them for a decade, congratulations, you won, but you should really consider having them back appropriately in a well-diversified asset allocation.
And within small caps, within medium-sized caps, what more specifically are you looking for just in order to determine the most attractive names that are positioned at this point?
Yeah, we're kind of one-note folks sometimes because we think dividend growth actually works really well as you go down in capitalization. Because if you go, let's say, to the Russell 2000, to small caps, and you want to take advantage of this valuation discount, you're faced with higher leverage. 2/3 of the companies don't make any money, and that can be a risk even in a mild recession. But you can find smaller companies that have those same attributes of the large cap dividend growers, and that can give you a prudent way to access that discount.
Cole, how are you feeling about small caps right now?
Well, I mean, I would agree with Simeon that as soon as you get out of mega caps, everything just looks relatively more attractive. I think the interest cost, to his point on the leverage, will be plausibly more biting. But I mean, how we look at the U.S. equity markets from an aggregate perspective, I mean, to touch back on the S&P, I think it's unlikely the S&P will make money in 10 years, including dividends reinvested. Even if we're wrong, we think it'll lose money in real terms unequivocally. So I just point that out because, while I can say that, there are some incredibly cheap stocks out there in the U.S. stock market, to Simeon's point. It's just not at an aggregate level. It's not a diversified level. It's not a broad level. I would say that the cheapest 10 to 20% of stocks rarely ever get cheaper. And that could be across capitalization in some cases.
Cole, what do you think is going to be the catalyst here for the markets to move higher? Is it all about the Fed? Is it all about the messaging? Or is it something else that maybe investors don't have on their radar right now?
Yeah, the investors need to pray what they've been hoping for a while, which is that the Fed cuts. And I just don't see that happening. That's really the only thing. They need liquidity, and the liquidity is just disappearing as we speak. Use the regional banking crisis as an example. Did that help or hurt liquidity? It hurts liquidity. So time and time again, whether it be the Fed, the regional banking, et cetera, I mean, go look at the IPO or SPAC windows. They've kind of got a little better, but they're nowhere near where they were. That's what you need for ebullient equity markets and really a bull market. And that's just not present. So the psychology is we're just cleaning up the froth from the prior era, which is terrible to say, but it's what happens over 10 and 20 years periods in stock markets.
Cole and Simeon, we want you to stay with us. We want to talk specifically about the banking sector. Now, Fed Chair Powell faced questions from lawmakers on the Fed's response to the banking crisis. With new regulations on the table, Powell raised concerns of how higher capital requirements could impact lending. A frustrated Senator Elizabeth Warren pressed Powell on his responsibility for the failures and the need for further action. Let's take a listen.
You take responsibility for your actions that led to the failures of these banks.
Yeah, I think the question of what happened, supervision was at fault. That's both at the board and at the reserve banks.
And are you ultimately responsible for those supervisors? Are you
Actually,
in charge here?
under the law, the vice chair for supervision has
Okay, so you
has
take
sole
no
authority.
responsibility
I didn't
on
say
that.
that.
Well, that's what I'm trying to ask. I'm
That's
trying
not
to
what I said.
understand what you take responsibility for.
I take responsibility for addressing the situation appropriately.
That's talking about
that's
going
my
forward.
focus. That's my focus. It's going forward.
Yeah, well, that kind of sounds like not taking responsibility for what you've done in the past.
We want to bring back in Cole Smead Capital Management CEO, and Simeon Hyman, ProShares Global Investment Strategist. So, Cole, I want to start with you. I don't know if you could hear what Senator Elizabeth Warren was pressing Fed Chair Jerome Powell on, asking about if he takes responsibility. Do you think that was a fair line of questioning?
Fair. I mean, it's politics. All is fair. I mean, that's the problem with it. So I would say I love Elizabeth Warren, just so we're all on the same page. Anytime she chastises an industry or an arena, you can make a pile of money in that space. So her sentiment is well heard. At the same time, I think if you think about the incentive structures of the regulatory environment right now, okay, if a senator comes after you for that, you're naturally, as the Fed, going to say, great, you know what? I want fewer banks to regulate because who wants to sit in that chair? Who wants to be Jay Powell? Who wants to be the vice chair of supervision, for example? You're not going to want to. So we're going to go from 10,000 banks in the United States of America to somewhere closer to 7,000 looking forward. We're going to lose 3,000 financial institutions. There's going to be less competition. Why? The incentives show that we're going there. It is not easy to regulate these banks. And at the same time, could someone say, yeah, the Fed hastened the decline of those institutions? Well, they could, because the rate hiking cycle was so hastened because of their lack of willingness to raise rates while things were quote unquote transitory. At the same time, those institutions did very stupid things. We could all read into the First Republic saga. It was just pure idiocy. And the reality is that's not Jay Powell's fault. I do not envy Jay Powell's position. I'd much rather get chastised by Elizabeth Warren and be in the money management business because I can make way more money.
So, I mean, how responsible do you think the Fed is right now, or was here, in terms of the current situation with the regionals? We have seen some stability, obviously, like Cole was just saying. A lot of those situations were one-off type of scenarios, very specific to what was happening inside those specific banks. But when it comes to, more broadly speaking, the tighter lending conditions, what that could look like here going forward, how has the Fed played into that?
So I'm sometimes surprised that the focus is so much on the regionals. So first, the good news, it's not a banking crisis. You know, we have 50% more capital since the financial crisis. Tier 1 capital is 15% instead of 10. That's protective. Number two, credit spreads have not budged, even at the height of all this stuff in March. But profitability is, of course, a concern. Those net interest margins are shrinking for both the regionals and the large folks. You get 5% on a money market, and we all have 2.5% mortgages. That's a problem, even if you didn't load up on long-dated treasuries. But the large cap guys have an extra hurdle. Number one, they may have to have even more capital, and they may have higher FDIC fees. So no crisis, but absolutely a profitability challenge that may be at least as heightened for some of the mega banks.
And so do you think bank capital requirements need to be raised? Because that's one of the ideas that's on the table.
It's not that I have opinion. It just looks like it's likely to happen.
And Cole, your thoughts on that?
Yeah, I think it would be foolish to raise bank lending, bank leverage requirements. I mean, because it will drive, to Simeon's point just a second ago, it's going to drive the larger financial institutions that already have those requirements to have more strength. And is that going to really create more competition? But if you're a politician, again, it's an excellent whipping boy to say these banks, they're problematic. Here's what they always create as crises. And to Simeon's point, this was not a credit crisis. This is not anywhere near the kind of problems we've had from a credit perspective in the past. It was a particular group of institutions doing stupid stuff. And there were more than just the ones that went out. We're going to clean up the banking sector because we haven't talked about commercial office yet. I mean, go look at Manhattan. We're back to 50%. It's like a big party's being thrown. And the reality is commercial office has got 2 to 3 years of refinancing problems coming.
So given that, Cole, are you avoiding regional banks at this point?
No, you want to dig around in there. The question is who has large exposure to those kind of things. Therefore, you don't know how bad it could be versus, if someone's, really long single family residential loan books, for example, that's a completely different game. Are you talking about defaults or people walking away from the building? No, the equity's too big. The question, to Simeon's point just a second ago, what's your spread? What are your cost of deposits against those loans that you have out in liabilities? And how bad have you been hurt by the rise in interest rates? But one other thing I'll add, I think the other idea that's going on in banking is that no one's going to borrow money at 6.5% or 7%. And that's just false, because with inflation running at 5%, that's only 1.5% to 2% real interest rates. That's a fabulous mortgage in real interest rates. And we haven't totally turned the psychology over to that yet. But go look at the building starts that were reported earlier this week. Housing hasn't fallen apart despite the fact that affordability's got a lot worse. And that's something that people said would have to happen. And yet, that's not something going for the Fed. Housing's not falling apart. That doesn't give them room to cut.
And Simeon, I got to ask you, so you guys have both made the points. Obviously, this is not like the financial crisis, but what are you advising clients with regard to exposure to the financials?
Look, there's certainly an opportunity to avoid financials in large cap stocks. We actually have a S&P 500 X Financials ETF for those who want to do that in very straightforward manner. But in regionals, you can pick and choose. I think I would align with that point of view. If you go back to the great financial crisis, remember some of those regional banks, they didn't want that TARP money, and it was kind of forced on them.
It was to make it look like
because we weren't supposed to see who were the good guys and who were the bad guys. So for the folks who may know who they're lending money to very well and have very specific loan books, there's certainly some opportunities there.
All right, we're going to leave it there for now. Cole Smead of Smead Capital Management, CEO, thanks so much for joining us here. And Simeon, stick around. Well, coming up, Under Armour shares slipping as Wells Fargo downgrades the stock on a lack of catalyst. Is its recovery story faltering? We'll discuss when we come back. Is the tech rally dead? Well, the Nasdaq has been taking a hit on expectations of further rate hikes. So is the FOMO melt-up over? Our next guest suggests looking to dividends for growth. We are back with Simeon Hyman, ProShares Global Investment Strategist. Before we get into those dividend plays, Simeon, just give me your sense just of where things stand coming off this massive rally that we've seen in tech since beginning of the year. Do you think we're going to start seeing this continuation of the rotation that we have seen over the last couple of days out of some of these larger tech?
Well, there's a little bit of it that makes sense. Yeah, I think when folks started to talk about higher inflation for a little bit longer, the Fed being a little hawkish, you say in the bond market you want to be short duration to protect yourself from that. And then I heard this weird thing, well, I should be short duration in stocks, which is a really weird idea because that must mean let me go buy stocks that don't grow so I get most of my money sooner. Except if you buy a stock that doesn't grow, well, then it's really like a fixed coupon bond and you're defeating the entire purpose of being in the stock market. And so I think some of this reversal is people going, oh yeah, stocks were for growth. Now you're at 30 times on the S&P 500 technology sector, so there's certainly a chance that that went too far in the hunt for growth, and we think there may be more quality growth opportunities.
So where is the quality growth opportunities?
So I think you can stay in technology. First of all, it's 28% of the S&P 500, so betting against it in its entirety would kind of mean you're almost clairvoyant. We in kind of the endowment space, you don't take risks like that. But as you suggested, we're Johnny One Note. We think that, I mentioned dividend growth earlier as a large cap idea, a mid cap idea, and a small cap idea. I'll share it in its most surprising place in technology. You can apply the dividend growth screen to technology stocks, which we do in our ETF ticker TDV, and find quality names. By the way, technology is the #1 contributor to dividends to the S&P 500. The strategy is equal weight, so you resolve the top heaviness of the market cap weighted index. And then finally, one more really important thing. Buybacks and dividends are not the same thing. All those tech companies doing buybacks, they're telling you the good times were yesterday. But when they increase their dividends, they're bullish about the future.
So, Simeon, it's interesting there because a lot of times people don't associate technology stocks with dividend payers, and they often overlook that aspect of the investment story. But when it comes to those screeners, you mentioned the screener for dividend. What about the screener for AI? Is that something that you think, clearly there are names within this market that are overvalued, that people have been jumping in just because of all this hype surrounding AI, but is there still money to be made in that trade?
I think any prudent asset allocation needs a small, some people would call it a satellite, a thematic satellite, that has a little bit of exposure to the most speculative potential transformational things in the economy. So you want a little bit of that. But that 28% tech sector thing, if you want prudent exposure as part of your core allocation, that may not be the place to have that core technology exposure.
But what about market psychology? That certainly comes into play, and it feels like it would be, kind of possibly misguided. I think about the Wall Street adage, the trend is your friend. So to go against the grain proves difficult, and especially like when you're trying to perform for your clients, asset managers trying to show, okay, why are you doing more poorly compared and playing a catch-up game. What do you think about the market psychology effect when it comes to the tech leadership that we've been seeing? And as Shauna pointed out, this AI just theme that's just fueling the advances with the Magnificent Seven and beyond.
And that's why you can't be prudently so far away from a market exposure in your asset allocation. You can't be so far away because none of us are clairvoyant. You have to have some exposure to technology. We think quality growth is a way to do it, but you have to be exposed to most of the market at all times. Look, if it's a small piece of the market, energy is an example. We were just looking at the screen. Oil's going down again. Nat gas is down 70, 80%. That's 5% of the S&P 500. You want a goose egg there, it's okay. But you can't goose egg technology. It's almost a third of the S&P 500.
One more time, those dividend growers in technology, what do you like best?
There's some interesting names there. You've got the old tech, you've got Microsoft, you've got Apple, but you also have some surprises there, like Accenture and MasterCard and Visa. So it's a really eclectic group of kind of old tech folks that are cranking out cash flow and dividends.
surprised by that. Thank you. All right. Thank you so much for joining us again, Simeon Hyman, ProShares Global Investment Strategist. We appreciate you for all the conversation today. All right, let's get a check on the market action. The opening bell just rang on Wall Street less than 5 minutes ago, and you're seeing a little bit of a downdraft continuing. It's been a theme this week. We're looking at the Dow down triple digits, down 235, S&P's down 35 points, so just shy of 1% there, 0.8%. Nasdaq, the tech sector, which had snapped its losing streak yesterday, back under pressure today, down 140 points at the moment. So we're continuing to see that trend of a downdraft on Wall Street this week in light of Federal Reserve Chair Jerome Powell speaking about the potential for the rate path and future rate hikes.
Yeah, certainly starting the day with some losses here. All right, let's check in on some of the individual movers. First up, we're watching shares of Virgin Galactic, the stock sinking today after the company announced that it's seeking to raise $400 million through the sale of common shares. We're looking at losses of just about 10%. The company may be on its way to erasing the gains just last week after it announced its first commercial flight into space is expected to take place by the end of the month. So the concern here obviously is on funding, what exactly Virgin Galactic needs to continue operating, to continue moving forward here. KeyBank saying that they timed the market well, but the funding is far from over.
Yeah, so it's definitely seeing that knock-on effect today. But when we look at this chart, it certainly had a big spike earlier. So it hasn't taken away all those gains that it saw. So, you know, some of it, it's the impact of that today's news, but some of it could be a little bit of profit taking as well, certainly, you know, with that big spike that they saw earlier. And, you know, it's still planning to test its first commercial flight later this month. So that's been a net positive for the company before now. Meantime, another stock we're watching, 3M shares popping today after settling a legal dispute. The company reached a $10.3 billion settlement with several U.S. cities and towns to resolve claims that the chemical and manufacturing giant contaminated drinking water with what are called forever chemicals. The company will pay out the money over 13 years to any cities and counties across the country to test for and clean up the substances in public water supplies. Now, 3M did not admit any liability, which often happens in these kind of cases. So you're seeing that, I guess, because this suit is behind it now, the stock gaining some steam on that. But certainly a difficult subject when we think about forever chemicals and the impact to health.
Yeah, certainly very worrisome there. Obviously, it's been linked to a lot of concerning medical conditions, including cancer. Right. When it comes to how the street is responding to this and why we're looking at a gain of almost 2% here in the first couple of minutes of trading, largely because, and I think Citi put it well in their comments this morning, it's a near-term positive. So yes, it is in the short term, 3M putting some of its legal troubles behind this, but there are other headwinds, though, that still linger. This settlement only represents a portion of 3M's ongoing legal liabilities, and that's expected to be well received here from investors in terms of, yes, this is a hurdle that they can put in the rearview mirror, but in terms of the legal liabilities going forward, 3M certainly has a lot to worry about, so some of those headwinds still remain. All right, Under Armour shares dipping on a downgrade from Wells Fargo. The analyst lowering the athletic company's rating to equal weight and slashing its price target to $8 a share from $12 a share. Now, the team at Wells Fargo is citing three main issues for Under Armour: outsized wholesale exposure, elevated inventory, and C-suite shuffling. Elevated inventory, that's something we've been talking about a lot when it comes to these retailers. Under Armour's elevated inventory was up 44% the last quarter. So they need to do even more here, really a lot, to clear some of that excess inventory that they've been struggling with. And that C-suite reshuffling. Their new CEO, Stephanie Linnartz, she's only been in the job for less than 6 months. So she hasn't had exactly the opportunity yet to really turn things around.
It's true. And she will have to focus, along with the rest of the executive team, on dealing with those inventory issues. We saw those issues come up with Nike as well. They got hit on that, especially because of their exposure to Foot Locker, which, you know, is a major wholesale client for Nike. So not surprised to see the inventory issues that Under Armour has. So this one will be one to watch and how they resolve that.
Yeah, certainly. And they were saying that the recovery story is now turning into a show me story, and it's likely going to be range bound here within the next 6 to 12 months. So we'll see whether
like that
Stephanie is able
line.
to turn it around.
I like that line in the note, the show me story, yeah. Show me the money. I remember that one. All right, coming up, we'll head overseas to Cannes, where our own Brian Sozzi and Brad Smith will bring us a conversation with an executive from Meta. Stay with us for that.
Yahoo Finance here at Cannes Lions Festival of Creativity 2023. Brian Sozzi, Brad Smith, and Nicola Mendelsohn, who is the head of the Global Business Group at Meta Platforms. Thank you so much for taking the time.
Oh, thank you for having me. I'm delighted to be here.
It's been an amazing time here at Cannes, just getting the ear of a lot of the execs that are in your position right now, and then also hearing what they have to say about the environment, not just here at Cannes, but when they go back to their desks, when they go back to those video conferences, and how they put a lot of things into action. What are you hearing from some of those execs here?
Well, I'm hearing that the execs are here because they want to learn and they want to understand what are the new things that are going to be either launching this week or they can expect to be seeing over the next 6, 12 months coming up. And there's a lot that's happening at Meta, and they're leaning in very heavily. Why are they doing that? They're doing that because they really want to understand what are the things that can drive their growth. And they're saying that actually Meta is a fantastic place for that. If I think about one of our fastest growing products, that would be Reels. And we did a whole slew of announcements this week about how we've increased the number of different advertising properties that we're actually putting onto Reels. So A, we're expanding Reels out to more territories around the world, to more verticals, which is exciting. We're also allowing now the ability to be able to actually drive to install apps through Reels as well, which is a really important thing if you're an app advertiser. You want to get discovered. Well, we're a fantastic place to be able to do that. So that's one of the things that's exciting, and it's particularly exciting because we've announced recently that there are now more than 2 billion shares every single day of Reels.
That's amazing to hear, because social media is essentially right now the new mall. It's where people find inspiration, though, on top of that. And now there's the shoppability element to it as well. But how would an investor of Meta platforms see that trickle through to the bottom line, even a new announcement, a new layering on of the user experience like that?
So what we would expect to see, and we're certainly seeing that at the moment, is they'll see the strongest return on advertising when they come to Meta. That's not what I'm telling you, that's what they're telling me all this week. A good example of that is actually how we're using AI. And we couldn't have a conversation, could the three of us, if we didn't mention AI, especially this week. I think it's become the kind of the Can AI conference in many ways. But we actually launched a whole suite of products last August. We call it Meta Advantage. It's all powered by AI, and it really helps advertisers reduce the number of manual steps when they're creating a campaign. It optimizes on the reach and the way in which you can find new consumers for you, and then ultimately how we measure as well. And we're seeing extraordinary return on advertising, upwards of 32% ROAS, which is extraordinary, and a 17% decline on average on the CPAs as well. So when you combine Reels with the Advantage product suite, that's when you get the really strong performance and the growth that advertisers are looking for.
A lot of folks we have talked to here have used this one word in particular in terms of ad demand this year. It's choppy. Do you see it choppy, and when do you see that situation loosening up a little bit?
That's actually not what we're seeing. Very much when we're talking to the advertisers here and the agencies here, yes, it has been a challenging period, especially over the last 12 months when we've navigated really choppy waters. And some of that uncertainty is still there. But what they're telling me is actually that they're finding now that they're baking in the uncertainty into their models, which is actually allowing them the freedom to be able to think about what they want to do and where they want to place their bets. I'm actually also seeing that the advertisers are becoming much more agile. And so they're doubling down on either the countries or the verticals or the products where they're performing, and they're actually moving budgets around. And that's certainly been a theme that I'm seeing here this week.
What's next for WhatsApp? I'm seeing a lot more on WhatsApp. It appears to be getting a more prominent placement, whether it's an earnings call or in some of the dinner meetings I've went to recently as well. But what is next for that platform, and how important is that platform in the Meta hierarchy at this moment?
Yeah, it's very important. And actually, we think that from a marketing perspective, that messaging in general, not just WhatsApp, but also Messenger and Instagram Direct, actually is going to be a crucial way for advertisers to reach consumers in new and in exciting ways. So we already have a business which we call Click To, which is where you place an ad in feed in Facebook or Instagram, and it directs you straight into the different messaging platforms. That already has a run rate of $10 billion, but we're just kind of getting going with that one. And then there's also the utility side as well. Think of this as where you might pay for messages for different reasons. A good example of that would be, well, we're in France, so let's talk about, the airline Air France. They're actually using this exactly in this way, which is if you book a ticket with them, then they'll actually deliver you the boarding pass and keep you updated all in one WhatsApp thread as to where, the flight is it taking off on time, etc., etc. These are just some little examples we're seeing in places in Latin America, in places in Asia, where there's a whole end-to-end commerce experience, whether it's with supermarkets or whether it's with, fashion retailers, where the people are coming in and having that whole experience and paying for the products right within the WhatsApp. So yes, we are talking about it a lot because we think it's a really exciting opportunity.
I'm doing some mental math here. We're about 17 months away from a U.S. general election. And for Meta platforms, the amount of advertisers that flow into all of the different subsidiaries that you do have, the pulse that we're seeing right now, even among executives, is that this is going to be a vitriolic type of election season next year. Has that showed up in where you're having conversations about how much they're booking, where they're going to be placing their advertisements, what they're going to be running up against in some of the user-generated content within Meta platforms?
Actually, it hasn't. But from a Meta perspective, it's not something we're waiting for the next US election. We actually have elections all over the world that are running almost every probably week or month. And so it's something that we prepare for in terms of making sure that we keep the preservations of elections is one of the most important things. And so we put accordingly significant resources against this.
Meta investors have heard a different tone from the top in CEO Mark Zuckerberg. This is the year of efficiency. We've heard this repeatedly. Has that message changed the culture of the company?
Look, I think it is something that we're, reflecting through as we go on, and he's been very public, both externally and internally, about this change and shift in mindset. But what's at the heart of it is what Mark wants to get back to is very much what made, Facebook as it was and now Meta really in the heart and the DNA of the company, which is to empower people to move quick, to innovate and to build. And what we've seen through the changes that we've made, which let's be honest have been some very difficult things to do internally, actually we're seeing a freeing up of the way in which people are thinking. And from my side, the product and the business teams have come together and we've never been closer than we are right now. And we're seeing that actually in the output from the product teams. I mean, I've talked to you about loads of new products already, right? And we're just getting going. So people can feel it. Yes, it's a change. Yes, it's a shift. But actually, I think it goes back to what actually is the kind of the secret sauce of what makes Meta great.
When will we feel the metaverse? When's that going to, as you kind of look out and model into the future and get the pulse of the teams that are working on and building that out, when's that going to hit critical mass from your estimation?
Well, I think, my Mark talks about it. It's a 5 to 10 year play in terms of when we're going to see that real kind of scale. But there's no reason why the three of us now had to come all the way to Cannes to do this. We could have put on some Quest 3s and just got into the metaverse.
Hold on. I wanted to be here.
There.
No, I wanted to be here. I hear your point, but it's kind of nice being here. Okay, sorry. Go ahead.
Well, actually, one of the office backdrops that I use in Horizon Worlds is actually a beach that kind of looks like this, which always makes the team laugh. So, yeah, we're not anywhere near where we envisage that it will be when Mark talks about that, 1 billion people will be using some form of AR and VR in the future. But we're really pleased with the progress that we're making. And as you know, there's Quest 3s coming out later this year that we're very excited about.
Head of the Global Business Group at Meta Platforms, Nicola Mendelsohn, thank you so much for taking the time here with us today.
Oh, thank you so much for having me.
Absolutely.
All right, that was our Brad Smith and Brian Sozzi bringing us the latest from Cannes. Now, despite the Fed's interest rate hikes, 10-year Treasury yields have fallen about 10 basis points so far this year. So what does this mean for investors? Yahoo Finance's Jared Blickery joins us from the floor of the New York Stock Exchange with some great insight. Jared?
Hey there, and we'll get into bonds in a second. First, I want to go to the Wi-Fi Interactive, where I'm looking at, as we've been saying, a downdraft on this Friday. Going to wrap up the week. Probably going to be a negative week. Nasdaq taking the biggest hit, down 1.25%. Want to show you the price action in the sectors today. Only utilities and real estate are in the green. It's tech and discretionary, that would be retail, taking the biggest hits here. Let's just take a look at what's happened over the trailing 5 days. Healthcare is the only one in the green. You could consider that defensive, but energy has taken the biggest hit, actually down 4%, followed by real estate, tech, financials. So overall, the market's taking a back seat. Everything I'm tracking in terms of leadership basically red this week, except for Bitcoin. Bitcoin is mysteriously up about 18% and kind of bucking the trend of the risk-off tone that has pervaded the rest of the market. And we had a number of big events this week. Powell speaking in front of the Senate and the House was definitely a big one, but didn't cause any disruptions in the bond market. We've seen bond market volatility go lower all pretty much for the last several weeks. Here's a look at the S&P 500 on the Wi-Fi Interactive. This is over the last 2 years. You can see just tracing out this very shallow bull right here, but I want to check out the Nasdaq 100 because we are just backing off this week from these highs that we saw in early 2022 in April. Also, you can take a look at the New York Stock Exchange FANG Plus Index, and that is testing record highs right now. So kind of a similar situation there. Not very surprising to see tech approach these levels and then pull back a little bit. Here's that ICE B of A move index, which I said was ticking lower. You can see this breakdown right here is that move lower. Also, I was writing about the VIX today in the morning brief, and the VIX has really quieted down. You look at a 13 handle, we actually went down to a 12 handle yesterday. Have not seen that in over 3 years. You have to go back before the pandemic. So volatility definitely calming down here. Final note, today is going to be one of the highest volume trading days of the year. Why would this random Friday in the summer be that? That's because it's Russell rebalanced day. In the Russell indices, you have the Russell 1000, which is a large caps, 33 names going to switch out there. And in the larger Russell 2000 index that tracks small caps, about 200 names, actually 197 that are going to change out there. So a lot of volume on the close today. This is going to be one of those last days that if you really wanted to make some big position changes in the middle of the summer, well, it's do or die, guys.
All right, certainly action that we need to keep track of. Jared Blickery, thanks. Well, coming up, Bear Grylls is an adventurer and a host, but could his lessons translate to the business world? We'll find out next. Bear Grylls is known for being an adventurer, eating and doing risky things in the wild, and sometimes taking a celebrity along with him for the ride. Our very own Julie Hyman sat down with Bear to discuss his new project, Mission Seeker, and he shared 3 pieces of wisdom. Take a listen.
Get the modern survival skills, which, as you and me know, modern survival skills, being literate digitally, is a modern survival skill. Always being adapting, because I think the media world, the technology world changes so fast. If you're slow to adapt, you get run over. Sometimes life sucks. Sometimes survival sucks. Things are hard. Get used to it. Keep going forward. Keep a smile on your face. Win the long game. Lose a few battles along the way.
That was some of the highlights there from his interview that he did with Julie Hyman. But Diane, what stuck out to me here is just this transformation, what he is focusing on now, and that's taking his survival skills to the digital world, to online, and really trying to educate the next generation about what they need to know in terms of misinformation.
I do like that because so much of our lives transpire online nowadays, and young people are facing such difficult issues with managing that, what's real, what's not real, especially with the progression of AI and generative AI and possible deep fakes, et cetera. So teaching younger people within this program of Mission Seeker just how to navigate the internet in general, and just coping and interacting with people. I mean, we both have young kids who are growing up in a different generation where just so much transpires there. So you need to be equipped. And how do you handle misinformation? How do you even identify if this is possibly misinformation?
Yeah, and this is an issue that not only the younger generation is struggling with, but the older generation struggles with as well, just in terms of what is put out there, what they should trust, what they can trust.
Right.
They need to know where to draw the line, where to turn to in order to get that best information. And he put it well in one of his recent comments here, just saying that the digital environment is the next frontier, and it's critical that we start this education process. We start it early. We really empower the next generation in the workforce, among leaders, to really best handle these types of situations.
Yeah, and interestingly enough, my kid's nickname, my nickname for him is Bear.
Is it?
Yeah,
That's a
because he
cute
looked like a little
nickname.
teddy bear when he was born, so I still call him Bear. I don't know if I'd be okay
nickname.
with him becoming an adventurer.
Yeah.
I mean, he might like that. An online adventurer with guardrails, maybe.
Oh no, I wish I could have my kids with flip phones for the rest of
Right?
their lives
Same.
until they're
Right.
21. But we know that's a little bit harder to say than do.
Yes, indeed. All right, check out the full interview with Yahoo Finance's Julie Hyman and Bear Grylls at 4 p.m. Eastern. Coming up, are investors unplugging from Tesla? We'll break down the EV maker's 2 downgrades in 2 days. That's next. are hitting 10 a.m. on the nose here in New York City. This is Yahoo Finance Live. I'm Diane King Hall alongside Shauna Smith this morning. We are 30 minutes into trading. We've got markets under pressure when we're talking about the major averages, but let's take a look at some top movers. CarMax's cost-cutting plan is paying off, and it's better than expected earnings report as the used car company grapples with what its CEO calls a, quote, challenging macro environment. Amid higher costs and supply shortages, shares are climbing this morning.
We're also watching shares of Starbucks after a union representing its employees warned of some stores striking today after claims surfaced that the beverage giant did not allow Pride Month decorations. You're looking at shares off just about 2%.
Shares of Wayfair lower today, despite MoffettNathanson upgrading the stock from underperform to market perform and raising its price target from $33 to $44, saying the retailer could experience 4 to 6 quarters of category outperformance in the aftermath of Bed Bath & Beyond's bankruptcy, still down a little over 1% at the moment.
And Nikola shares are falling after a fire broke out at the EV company's headquarters in Phoenix. Now, fire crews are currently on the scene. The Phoenix Fire Department saying that 4 trucks caught fire during the incident and is advising people to leave the area. In a tweet, Nikola says that foul play is expected. You're looking at losses just about 8%. Well, investors are unplugging from Tesla with shares sinking lower today, off just over 3%. The EV maker facing 2 downgrades in just 2 days this week. One from Morgan Stanley, the analyst there, Adam Jonas, and the other from Barclays. So where does the company really stand? Yahoo Finance's Pras Subramanian joining us now. Pras, we know Tesla, obviously a massive favorite here among investors since the start of the year, this huge run up, but a downgrade particularly from Jonas. That's pretty big.
Yeah, I mean, he's a pretty long-time bull on Tesla, and Dan Levy the day before, also not a bearish analyst on Tesla, both downgrading, but basically saying that the stock is not tied to fundamentals right now. You know, not really much news other than some charging deals here and there that are good, but not really needle movers for the stock. So basically, they're talking about how Tesla got caught up in the AI run-up with a lot of AI stocks like Nvidia. But basically, it's for Levy, it's a long-dated opportunity. For Jonas, he's saying generative AI and AI for driving are 2 different things. It's not the same thing. They're not the same sort of companies like Nvidia and others that are rolling up into that. He says we should kind of detach this from reality, wake up from the AI dream is what he's saying. But he says both analysts say the stock is still a long-term own in the space. Like it is a category leader in EV. So, just you might want to own it, but not so much right here. In fact, Jonas says don't re-rate the stock here based on this AI stuff. He raised the price target because he sees some upside, but not enough to keep buying here at these levels.
That's what I was going to say, because the one thing I noticed with his note was that it seemed kind of balanced and playing both sides of the coin, if you will, with regard to Tesla. And certainly, seeing the pullback today, we're seeing that knock-on effect of both of those downgrades. But with regard to it being the front runner in the EV space, with both of the analysts, did we notice that they see Tesla continuing to just hold its position?
They both said that in the near term that estimates need to come down for Q2. They're too high right now. They say that for the near term there's going to be some sort of a little bit of a dip there, but long term based on stuff like software, battery technology, the ability to actually outsource software and battery technology to other companies, Jonas noting is that is a big opportunity for them. So there's long-term play, it's still good, but short-term there might be a little bit of hiccups here as sort of the analyst community might be too bullish on their near-term numbers.
And lots of questions just about the pricing strategy that's been laid out here from Tesla, really the price cuts and then raises that we've seen since the start of the year. We also want to bring in Rochelle Akufo, who's joining us from down in DC for the remainder of the hour. Hey, Rochelle.
Hey, Shauna. So yeah, Pras, I wanted to ask you because, when we look at the deal with GM and Ford when it came to Tesla as well, do you think that these downgrades, do you think they're fairly justified, at least in the near term?
I think what's happening is that they need to downgrade the stock because if you're a fund manager and you have an index, I was talking to Miles about this. If you own a portfolio of stocks, Tesla keeps going up in terms of price. You kind of got to take a little bit off the table to sort of rebalance your portfolio from like a big institutional ownership point of view. I think that's what's going on there. It's a downgrade based on the fact that we need to lighten up ownership of the stock because it's getting too high for if you were to manage a sort of fund. But for normal investors, more about a watch out here. Yeah, you might see a little bit more pops in the stock going into Q2. You're going to see the delivery numbers come out at the end of the month, so we'll see that. But maybe it's more of a cautionary downgrade right now, not so much that they actually hate the stock right now.
Fair enough. And that's important context there. Pras Subramanian, always good to have you. Thanks so much. All right, taking a look at housing starts, they rose for the second straight month in May, with construction on new homes reaching the highest level since last April, boosted by strong demand, which our next guest says could be a very favorable environment for homebuilder stocks. Rafe Jadrosich, Bank of America senior homebuilders analyst, joins us now with more. Good to see you, Rafe. So as we look at some of this data that's been coming out over this past week, then, which of these homebuilders are in the best position right now?
Sure, great. Thanks for having me. So we do think it is a favorable backdrop for home builders right now. New home sales have definitely inflected positively year to date. We've seen a strong recovery after the slowdown at the end of last year. So if we think about specific home builders that we like right now, Toll Brothers is our top pick. We think it's really attractive on a valuation basis. It's trading just slightly above its book value with a return on equity that is far above its historical average. We also think it's well positioned to benefit from the tightness in the existing home market that you've seen out there.
Rafe, you all recently had a housing symposium earlier this month with home builders in attendance. What were the top 3 themes that you would say came up?
Yeah, I think the really big theme this year that's come out is just the tightness in the existing home market right now. There's just not a lot of resale inventory that's on the market. Historically, if you look at new home inventory as a percent of the total inventory that's available, it's about 10 or 15%. Right now, we've actually seen that increase to 30% of the total available inventory. And it's just existing home inventory is very tight. There's a rate lock-in effect that's going on right now, where about 80% of current homeowners that have a mortgage that's below 4%. So while mortgage rates are 7%, the incentive to move is very low. I think that the second kind of key takeaway that we had was that home builders are accelerating starts. You saw the data that came out earlier this week. Just in response to the really strong demand, we're starting to see a pickup in overall construction activity. And then the final, I think, takeaway would just be the supply chains are starting to ease. Still elongated build cycles, but we are seeing a little bit of relief there.
Yeah, Rafe, what are we seeing in terms of input costs? Because yes, we have seen some relief when you look at the price of lumber, for example, down substantially on a year-over-year basis. But in terms of how big of a challenge this is for home builders compared to what it looked like pre-pandemic, how does that stack up?
So if you look at the overall cost to build a home from 2018 to now, we think it's up about 45% if you just look at the materials. And home prices are up 47% over the same period. So we've still seen a lot of inflation. There is relief coming in right now from lumber costs, as you said. Lumber costs are down over 50% year over year. And that's the largest single input from a material perspective. When you look outside of lumber, the rest of building products generally are still inflationary. Labor is still tight, and land prices still haven't come down. So generally still an inflationary environment if you back out lumber, but lumber is a big tailwind to margins right now.
And Rafe, as we look year to date at some of these home builder stocks, some of them have been absolute rock stars. When you look at D.R. Horton and Lennar, they're both up over 30% year to date. Toll Brothers up over 50%. KB Homes up more than 60%. How much more upside do you still see then coming into the second half of the year?
Yeah, it's a great question, and the stock performance has been really strong, especially relative to the rest of the market. I think what's important about home builders is that the valuation is still below the long-term historical average. So usually they've traded at an average of about 1.5 times book. So the book value per share is actually increased by more than the stock prices over the last few years. So we're still probably about 10 or 15% below the historical long-term average valuation. So we still see some upside on the valuation side.
And Rafe, I got to ask you about with rates expected to climb through the rest of this year, what risk do you project that posing to the home builders, for instance?
Right. So obviously the 7% mortgage rate is definitely a big headwind to affordability. If you look, about a year ago, beginning of last year, mortgage rates were at 3%. They've gone all the way to 7%, a huge headwind to affordability. What we've seen is mortgage spreads, so that's the spread of the 30-year mortgage over the 10-year Treasury, are at all-time high levels. So even with the FOMC announcement last week and the commentary that you're still seeing 2 rate hikes, mortgage rates have actually gone down slightly over the last 3 weeks. So we think that spread is more than capturing the additional hikes that are coming, and mortgage rates we'd actually expect to be flatter down through the remainder of this year.
Rafe, what about pricing? Because we entered the year expecting, many were calling for a double-digit decline in home prices. We haven't seen that yet because demand has remained strong, inventory a huge issue, and people are willing to pay what people are asking for homes. Is that going to continue to be the case, do you think?
So if you look at new home prices, they're probably about 10% off of the peak levels. And that's a combination of incentives and price cuts from the home builders. And then we've seen a stabilization there. So there has been elasticity in the market. From the existing home side, it's been relatively stable. We're only 1 or 2% off of the peak level. And the story there is just the lack of available inventory. But home builders have seen a stabilization in prices. And there's actually some markets where they've come back and started to increase price again. So we would expect a kind of pricing to be stable between now and the end of the year.
And obviously, once you have the demand, you do want that supply. You know that inventory is an issue, but you also have a tighter credit environment. So what is that doing for construction loans to be able to get some of these buildings off the ground?
Yeah, that's a great question. So there's two aspects of credit. You have the consumer borrowing side on the mortgage rates, which we talked about how elevated they are, and then you have home builders that are borrowing to finance their business. From a private builder perspective, which we think is about a third of the market that rely on construction loans, the NAHB survey on the current cost to finance a single-family construction is 12.8% as of the first quarter. That's up, over 500 basis points over the last 3 years. So the cost to finance for a private builder has gone up really materially. So we think that actually positions public builders to take market share as private builders come under some cost pressure.
We'll certainly keep track of that. Thank you for joining us with your insights. Rafe Jedrosic there, Bank of America Senior Home Builders Analyst. Thank you for your time this morning.
Great. Thank you for having me.
All right, coming up, regional bank Western Alliance's CFO joins us next. How this sector is faring in the wake of March's crisis. Next.
never know who you find at Cannes Lions. So I'm having a power lunch right now, a power lunch with Sir Martin Sorrell, S4 Capital Partners founder. Not many people get to have a power lunch with you, Sir Martin, so thank you for joining us. We appreciate it.
Well, we haven't had much of a lunch.
We had lunch, we have some coffee,
Jesus,
we have some water, you know.
I've had water and that's it.
All right, we'll get it after. We'll get it after this interview. So talk to us. You're a veteran of Cannes Lion events. What do you think of all the tech companies here?
Well, it's become a tech conference. And what do I think? I mean, look, you've got the 6 big platforms, the 3 Western and the 3 Eastern. So you've got Alphabet, you've got Meta, you've got Amazon, you've got Alibaba, Tencent, and TikTok, or ByteDance. Then you've got the smaller platforms like Twitter and Snap and Pinterest. And then, of course, you've got the Microsoft, Apple presence, because that, with AI in particular, is going to become, and the metaverse. I mean, you saw Apple's announcement around their new headwear. So I think that those are those 8 companies, plus Nvidia, obviously supplying the picks and shovels, and then I would add Salesforce and Adobe. I think that's where, and interestingly, because of the regulator trying to stop Microsoft on Activision, stopping Meta on Giphy for no good reason, and the only reason could be that big is bad, right? There's no logical argument about cloud gaming or scale on Giphy. I mean, you could have solved that in a heartbeat. So with the regulator putting pressure on them, it means that those companies are going to become even more focused on organic growth. So their research budgets are huge.
Let's go back to Apple. Made a lot of headlines with these fancy looking glasses. Is that an opportunity for the end industry? How does that change what this industry does?
Well, it is.
How does it change media?
I would guess that companies like Apple are going to be coming out rapidly with announcements in the AI space, just as we've seen from Alphabet and Microsoft. I mean, Alphabet have been working on it since 2014. I mean, they're the father or mother of this. So I would wrap it around 3 things: blockchain, metaverse, and AI. And AI, or AGI, has already started to impact visualization and copywriting. That's one thing. Hyper-personalization at scale. So if we thought we could produce for Netflix, 1.5 million creative assets, we're going to be able to do multiples of that. The third area is media planning and buying. Why rely on a 25-year-old media planner or buyer when you can rely on an algorithm with us checking it? You wouldn't give your budget to Rupert Murdoch unsupervised. I mean, there's nothing against Rupert or that he would do anything wrong, but you want to have a validation. So we validate, we resell, if you like, and we watch and we monitor. So that's the third area. Use as a super tool for improving our own processes and client process. And then the thing I think, which is the most important thing, is knowledge sharing. So, the guy who resigned from Google because he thought the bots would be an existential threat. I think actually it's sort of the reverse. You can turn human beings into human bots because you can transfer knowledge with them. And as long as the data that you ingest into the platform is right, and over time it gets better and better, and as long as you open it up to everybody in your organization, so all our 9,000 people will have access, God willing, to all this information.
What's your economic outlook? I'm assuming you met with a ton of people. You always have a good pulse on this stuff.
It's tough. It's tough. I think 23, 24, in the presentation I did on Monday, I finished it off with 23, 24 is going to be tough. I mean, the stuff in the last few days around interest rates, what Powell said, what the Bank of England have done in the UK, it looks like, GDP will be lower than before. Interest rates, inflation will be higher. I mean, it's not going to go down to 2%. And interest rates will be higher for longer. So that has not bitten into the economy. I mean, it's quite interesting watching what's happening about mortgage rates in the UK. Consumers are now starting to complain bitterly about, as they refi their mortgages or renew their mortgages, about the increased cost. And they've never really focused on it. So they didn't have variable rate mortgages, they had fixed and had to refi them. And that's starting to have a huge impact, I think, on consumer sentiment. So I would say, the chances of a recession, Goldman, I think, have it at 25%.
Yep.
but GDP growth in the US around 1.7. The world's a different place. It's a much more fractious, fragmented place.
I've asked a lot of big CMOs, we've had a lot of CEOs on Yahoo this week, how they plan to advertise and approach and lead during what could be a very polarizing, another election next year. What is your sense of this? How are companies going to advertise? Are they going to pull back, you think, during next year?
The geographical fragmentation means you have to select your markets much more. So North and South America, the Middle East, and Asia, and I'm going to say not ex-China, but if you've got a big position in China, you're not going to go more because of the tension around Taiwan. If you have a small position, I think Unilever has 7% of its revenues in China, for example. So and it should be around 20% because China's 18 trillion out of 100 trillion GDP, and 2050 it'll be the biggest. So that's one thing. Europe, the runes are not so good. I mean, people are looking more from a cost base than cutting costs than revenue growth. So those will be the growth markets. So in Asia, it'll be India is the big gainer. Modi's in America, and playing both ends off against the middle, but doing the right thing by India, and I think that's growth. Indonesia, Vietnam, Thailand, the Philippines, Malaysia, Singapore. So that's the sort of geographical. On the technology side, because it's lower growth, and therefore the focus will be on quarterly growth, like-for-like growth, and margin, that's going to mean that the digital transformation is going to be accelerated. So I think what clients will be doing is there'll be more activation and performance, more lower funnel, what we call lower funnel work, less strategic work, very focused on results, very focused on performance, ROI, measurement, and then geographically they're going to be much more selective. It used to be, last 50 years, it didn't matter where you went, if the demographics were with you, you did well. Now you're going to have to be much more selective. And so it's a very different world to the last 50 years.
We will leave it there. Sir Martin, you're always gracious with your time with Yahoo Finance. I will let you get back to your, meeting? How many meetings have you had?
Too many.
Too many. All right, we'll leave it there. Brian Sazi out.
U.S. small and mid-sized banks across the country faced a crisis in March that sent investors reeling. Up until now, the sector has settled, with the majority of regional lenders seeing a rally in recent weeks. But where do we go from here? Dale Gibbons, CFO of Western Alliance, joins us now, along with Yahoo Finance reporter David Hollerith. Dale, it's great to see you. So certainly we have seen some stabilization within your sector. Western Alliance shares are well off. They've rallied well off the lows. Still, though, off about 40% since the start of the year. Just first, give us a sense of the shape that your bank is in today.
We're very strong. I think it was a little unusual that we got kind of pulled into this to begin with. It was really our relationship with relative to Silicon Valley Bank, and that we have a company called Bridge Bank, one of our subsidiaries, and it's a direct competitor to SVB. And I think that's what kind of pulled us in initially, even though we don't have many similarities to SVB beyond that. And as a result, I think we've educated our depositors and the street to some degree about that, and that's the reason why our stock has recovered significantly, but still below where it certainly was at the beginning of this year.
Hey Dale, David Hollerith, thanks for coming on. I think to your point, the points you're making, for regional bank stocks, investors have sort of had kind of a crazy go at it during that period. Obviously, short sellers did go big into the market, but I think we're curious to understand more about what was going on inside the bank during those early days. Obviously, it must have been a difficult time, and I'm really curious about what you had to do in your job.
Well, I appreciate that, David. It was a bit frenetic initially. On March 10th is when SVB was taken over. Our stock was about $50. Getting to your comment in terms of short sellers and some unusual put activity, I would say, we opened out $12 on that Monday, the 12th, or the 13th, and as a result of that really was picked up by the media. And that really kind of spun up, a situation. And depositors would look at the stock price and they'd say, gosh, the equity markets are telling me something I don't know. I need to be able to respond to that. And I think that's really what precipitated some of the withdrawals we had. And it really was almost only that first day, that March 13th. So we quickly put out an 8K and a press release describing how different we were from SVB. Our insured deposit levels are more than 10 times what theirs were back then. And so, and as we did that, I think it calmed things down, that our stock more than doubled going into the close on that Monday. But and then since then, we've really undertaken a method to inform our depositors of what goes on in terms of some of the shenanigans from short selling, and also had them sign non-disclosure agreements if they were interested. And we tell them exactly where we were on deposits and where we were on rating agencies and things like this. And I think that's really strengthened those relationships that we've had. And it's given us a profile now where we're growing deposits again, and we're at quarter to date, and we expect to be at quarter to date by the end of this month.
So, Dale, as you look forward, it doesn't sound like you guys had any sense that something like this was coming, that something like this would be such a large threat here to Western Alliance. When you talk about some of those lessons, and you've had 2 months now to reflect on what has happened, how has that shaped, or how are you reshaping Western Alliance here going forward?
Yeah, well, we did see that, SVB in particular, had a very large debit. It's a little bit hidden because it's not on the front of their balance sheet, but in their held to maturity securities. In their footnotes, you can see they had a $15 billion loss that was unrecognized, and that was greater than their capital. So that should have been highlighted more. We're highlighting that today. We're highlighting, where we stand in terms of our capital levels, including, any embedded losses, which for us are really nominal in the held to maturity portfolio. We've also learned, in terms of kind of, behavior of depositors. So in terms of the tech space, I think people were a little surprised, not only how quickly the deposits move, but how much of an effect they went in unison. And so, so we have maybe a little different assumption set in terms of how stable those deposits might be going forward. But, one of the things that I don't think has really been noticed enough is each of these banks that failed, all of them were essentially monoline institutions. So SVB was a tech bank. Signature Bank in New York was largely the crypto bank, and First Republic was the private bank. We pride ourselves on diversification. We're really doubling down on that today. And one of the reasons why this only had a limited impact on us was because the tech space, the parallel part that we had with SVB, was only 13% of ours versus almost all of theirs. And so that really kind of helped, ring fence, kind of the risk that we had and that we have now gone past.
Yeah, and Dale, just sort of us getting a broader look at sort of the economy from the perspective of banks, it's been talked about a lot in recent weeks about how important regional banks are to the U.S. economy. And there's something like 4,700 different banks in the country. And I was kind of curious if you could go more into that, just as someone who is running the financials of a bank. What exactly is it about regional banks that is so important to the economy?
Well, I really appreciate this question, David. I mean, regional banks, for the most part, have been growing at a faster rate than the large banks. And so just why is that? They must be doing something that the public appreciates. And what I would say that it is we're typically faster to market, we're faster to decision making. We don't have, the bureaucracy. Bureaucracy tends to grow exponentially as you get larger. And that just slows everything down. The other thing as well is, I think most people are aware that posted rates at the large banks are very nominal. You would not know that interest rates are up 500 basis points, 5% in the past year, if you bank there. But meanwhile, the regional banks and a lot of the smaller ones as well, have been much more responsive to the kind of the change in rates. And so I think it's all about this, our ability to really hone in on what the client needs. The larger something gets, the more cookie cutter processes tend to be, and that really doesn't work for so many businesses.
Yeah, and I think to sort of follow on that too, the rule now that is sort of well known to the market is that banks will continue to have their profit squeezed, given that we're in a higher interest rate environment and interest rates do not appear to be lowering anytime soon. I'm curious, how much does this change the business model for regional banks from your perspective?
Well, I think there is an important element here in terms of, how are regional banks going to continue to be able to grow? I think you do need more clarity, and I think the revisions in terms of some of the deposit insurance mechanisms would be helpful in that regard. As a result of what's taken place, typically is how you get a large bank is it's a small bank and maybe it acquires some banks and it grows organically and becomes large over time. Well, as part of that becoming large, you're going to be working with larger companies, you're going to be making larger loans. And so when your loans get into the hundreds of millions of dollars each, but you only have deposit insurance at $250,000, meanwhile, the large banks are presumptively too big to fail, i.e. all those deposits are safe, it slows down your ability to provide funding to be able to make those larger loans. And without some mechanism to do that, I think you're going to end up with more of a barbell in terms of the banking industry. You're going to have very large institutions that are all again have the assumption that they won't be closed down. And then the very small ones, they're community banks, but they can't really service larger commercial clients. So what do you do in the middle? That's where the regional banks are. And I think it does make it more challenged in terms of being able to push funding higher without some mechanism to be able to provide more confidence to the depositors in terms of those funds that are residing at those institutions.
And Dale, going off that, I guess, would you welcome more regulation? And to that degree, what do you think, or is there anything that needs to be done in order to put a bank like yours, but the regional banking sector at large, on firmer footing?
We welcome more regulation. I think that, I look at what happened to SVB, with their large debit in their securities book. That is something that should have never been allowed. It was a management failure. I think it should have been, pounded on by the regulators. That really didn't happen either until it was too late. To me, that's a better solution than just throwing capital. Capital is really important. That is a fundamental element of confidence that the public can have. But capital, it doesn't replace incompetence. And so you really need both to be able to do that. Capital levels in the U.S. are higher than almost anywhere else in the world. I think it is a strongly capitalized industry. But again, there were some there were some certainly some management failures, and regulatory oversight could have been more robust.
Yeah, and just to get into that a little bit more, we heard from the Justice Department earlier this week, who had, their antitrust division had sort of come out as saying they wanted to update guidelines for bank mergers. And obviously there are these capital requirements that also appear to be coming as proposals soon. And I'm just curious, what has the conversation been like with banking regulators for Western Alliance?
Well, we all share the same goal. We all want a strong industry. We want high confidence from the public, in these institutions. We think that contributes to not only the success of, Western Alliance, but the industry at large, and really moves the economy along. I mean, banks are the primary provider of credit, that really is the engine for the economy. And so pushing that forward, we all share that same goal.
All right, Dale Gibbons, CFO of Western Alliance, we really appreciate you taking the time. We hope to have you back again soon here at Yahoo Finance.
Thank you for your time.
And of course, our thanks to David Hollerith as well. All right, well, coming up, what Fed Chair Jay Powell's testimony tells us about the outlook for inflation. Where do we go from here? Well, we've got more on that for you next. Fed Chair Jay Powell testifying before lawmakers this week, where he addressed core concerns about the state of the U.S. economy. Well, one major issue for the central bank is, of course, inflation, which has yet to fall, and it's a far cry from the 2% target.
Headline inflation has come down by essentially half, but that's largely due to energy prices coming down and commodity prices that go into food coming down. And those are not, I won't say that they're not affected at all by monetary policy, but they're principally affected by other things in the economy. Really, where monetary policy takes effect is in the service sector, and that's where we haven't seen much progress. So, but we are seeing progress in other places, as you point out. Inflation broadly is coming down, but as I said in my remarks, we still have a long way to go.
All right, well, joining us now is Gina Smialek, a New York Times Federal Reserve and economy reporter, also author of Limitless, the Federal Reserve Takes on a New Age of Crisis. Gina, it's great to see you. So let's just start with what Powell was just saying when it comes to inflation, the fact that it is much stickier than what the Fed had anticipated it would be, which much stickier than what many forecasters had anticipated it would be. Can we jump to any conclusions just about the progress that we have made on inflation, what that could then tell us about the pathway forward, or is that going to look very different potentially?
It could look potentially quite different from what we've seen so far. So we have seen a lot of disinflation on sort of that headline basis. So when you look at overall price increases, they are down from a peak of 9% last summer to about 4% now. So that feels really good. But unfortunately, the remainder of getting inflation from that 4% to the 2% goal could be a real challenge. You know, we are in a situation where we have relatively rapid service price increases, and those can be much stickier. I mean, that's what we're seeing really around the globe right now. We're seeing rapid service price increases in England, in Europe, here, really across advanced economies. This problem's pretty shared. And so I think from the Fed's perspective, that's a reason for concern. You know, they're worried that this is going to be a harder fight from here on out.
So then which aspects of inflation in the economy can the Fed take credit for versus luck from some of these outside factors, things like regional banking, also contributing, and macro conditions as well?
Yeah, absolutely. So I think that it's a pretty big portion so far has been either luck or something that we expected. So we saw a lot of healing in supply chains after sort of a very tough period for supply chains right after the pandemic. And that's helped to bring down goods prices. We've also seen gas prices actually fall outright compared to where they were last summer, which is really about the war in Ukraine and some of those supply issues. And we've seen commodity prices really come down, which matters for food prices. So at the grocery aisle, things are a little bit less painful than they were before. All of that is great news for consumers, but not necessarily something that the Fed has directly caused. Interest rates don't really affect egg prices. That's more about, the avian flu and its trajectory. And so that's really where we are right now, is there are good things happening. There's a lot to be happy about. It's not totally clear that it's all Fed policy at this stage.
So, Gina, I want to ask you, this is Diane speaking now. I know you're talking to like three ladies right now. She's like, who's talking? Great to chat with you again. So you did a deep dive into the impact of inflation, not just kind of the highbrow level of where it stands, what the Fed has done, and the overall impact, which we will continue to see play out, because obviously it takes time from the actual move to see how it actually impacts inflation. So let's talk about households. Are people really comfortable? It seems like Fed Chair Jerome Powell is not comfortable with the level of where inflation is, but are people comfortable with where it is?
You know, it's interesting. I've talked to a lot of people over the last couple of weeks just for various stories I've been working on about their inflation experience recently. And one thing you will consistently hear is that people are feeling a lot better about inflation in light of how much gas prices have come down. I think for a lot of people, even though gas prices are really this sort of idiosyncratic part of inflation, they move around for a lot of one-off reasons that policy can't do much about. I think they are very salient to a lot of people. And so that has mattered. I would say that when I talk to people and they're still feeling bad about inflation, it is often the case that traces back to food inflation. Either they eat out a lot and sort of away from home food, restaurant meals, fast casual meals, those have all remained very rapidly increasing in price. Or it will be the case that they've just seen their grocery bill go up so much in a relatively short period of time, and it isn't coming back down. When we talk about disinflation in groceries, we're not talking about deflation. Like, grocery prices aren't climbing as quickly, but they are still climbing. And so that makes some people feel very bad. So I think it's a bit of a mixed bag from a consumer perspective.
Gina, what about the messaging from the Fed and how the market is interpreting this? Because it's happened time and time again, and we just saw it even within the last week or so at Fed Chair Jay Powell coming out saying that 2 more hikes will likely or could potentially be necessary in order to get a better handle on inflation. Yet the market wants to discount that. The market is trying its best to ignore it. Why do you think that is?
I think this is such a complicated time to be a Fed watcher, because what the Fed has said here is we think we're going to do 2 more rate increases if the economy proceeds basically as we expect. And that, as we expect, it kind of gave us the rough contours of what that looks like. It looks like pretty rapid growth, not super fast, but better than last year. It looks like very low unemployment and just kind of generally more of the same of what we've been seeing recently. Now, I think for economists and market watchers and investors across Wall Street, what they're saying is there's some solid chance that actually the economy deteriorates. Actually, that sort of steady sort of forecast that the Fed has laid out does not materialize. And I think that is why markets don't believe the Fed, that they are actually going to make these 2 rate increases. I think it's less that they don't think that they would if they felt that it was necessary, and more that they don't think it's going to be necessary. They think the economy is going to slow down. They're really looking at the recent tick up in jobless claims and saying, hey, the job market's about to crack. We just haven't seen it yet, but it's coming. And so I think that's where that disconnect is coming from, especially, when I talk to sort of investors who are very Fed focused. That's kind of the narrative that they're telling me. And a lot of Wall Street analysts actually agree with investors. They are not betting on a higher Fed interest rates this year. And so, I guess we'll see how it shakes out.
And obviously, when you think of the things that people prioritize, you mentioned obviously gas, groceries, but you also have a roof over your head, but you also have wages. I mean, we're seeing some of these companies continuing to pass on some of the costs of having to pay these higher wages. Consumers are still spending, though. And so it seems like this cycle that we don't seem to be able to break. What do you think is actually going to end up breaking it?
Yeah, so theoretically, when this happens, this is exactly where Fed policy works. It's an unpleasant thing to say, but I think it's the reality, is that the Fed basically slows down the economy by cooling off the labor market and making sure that we aren't earning as big of wage increases. And as we earn slower wage increases, we pull back on our spending and demand pulls back, and you get that sort of, cascading slowdown through the economy that eventually brings inflation in line. It's a painful process. The Fed's the first to say it's a painful process, but that's basically how interest rates work. And so I think the idea is that if the Fed has pushed the economy enough, if it's kind of gotten it to that pain point, we should start to see that pull back. We should start to see weaker wage growth, and that should translate into less demand and slower price increases. The challenge is that we do seem to be seeing some early slowing in wage growth, but it remains very rapid. It's been rapid for a while, and inflation is coming down, which means that for the first time in a few years, people are actually taking home real wage increases. Even after subtracting out inflation, you still are getting a wage increase. And so I think, it's sort of, tough along that dimension. It's been difficult to slow down an economy that has this much momentum enough to really sort of wrangle wage growth out.
And Gina, some critics say it's the Fed's fault we're even here in the first place, and kind of this catch-up mode, if you will. And, critics say we've done enough, just stop. Is that valid criticism?
It's an interesting question, and I think the Fed itself is asking that question. Have we done enough? Can we stop? The challenge with monetary policy, and this has, been the case for sort of time immemorial, is that it works with a really big lag, but we don't know how much that lag is. So what we know is that it takes somewhere between several months and several years for interest rates to fully affect the economy, which means that you don't want to be raising interest rates until you actually see the economy crack, because if you do that, you've probably gone too far. The flip side of that is the Fed does not want to err on the side of overcaution, not do enough to slow down the economy and allow inflation to just persist for year after year after year, because then it's going to become part of everyday life. It's going to become part of human behavior. We're going to ask for bigger wage increases to cover the inflation. Companies are going to put up their prices more regularly. It's going to get really entrenched, that inflation, and then it's going to be even harder to stamp out. And so I think that's what the Fed's trying to do. It's trying to weigh those two challenges against each other right now.
Indeed. Remember, Powell did caution about he'd rather go too far than do too little and then be back in the same position all over again. We'll have to see how this plays out. Appreciate your breakdown today. Gina Smilek, their New York Times Federal Reserve and economy reporter. Have a great weekend.
Thank you.
All right, coming up, Yahoo Finance's Ali Kanal joins us with a look at the future of Netflix. What's on the horizon for the streaming giant? More on that next. Could some major content changes be coming to Netflix? Yahoo Finance's Alexandra Canal has been talking to experts and tracking the latest developments in the streaming company strategy. So, Ali, what are you hearing so far?
Hi, Rochelle. And yes, we have been hearing a lot of news out of Netflix over the past few weeks, especially when it comes to its content. And remember that in the background of all of this is Netflix's profitability push. And we've seen the streaming giant really lean into certain revenue initiatives like the crackdown on password sharing, along with the ad-supported tier. So what does this mean for the future of content? And analysts that I've been speaking to have told me that really Netflix is entering the next phase of this growth. If you remember back in 2017, 2018, Netflix signed on a lot of A-list talent, committing to multi-million-dollar, multi-year deals. And we just heard earlier this week that one of the first producers to sign with Netflix, Ryan Murphy, he's not renewing his contract with the streaming giant. In fact, he reportedly will be heading to Disney. But Murphy signed a massive deal back in 2018, $300 million for 5 years. That wasn't the only one. Netflix also signed Shonda Rhimes at the time for $100 million. They recently re-upped Shonda Rhimes' contract. So what could this mean when it comes to future deals for Netflix? And analysts have told me that it's likely we might not see these massive deals any longer. Rather, Netflix might be a little bit more strategic about the contracts and the money that they choose to commit to. Now, part of that strategy is leaning in to two main areas of growth. One is international content and one is live sports content. So on the international content side, we just saw Ted Sarandos visit Seoul. He reiterated his $2.5 billion commitment to creating original Korean content. In addition to that, he also said that the company is looking to foster talent behind the camera as well. And analysts that I've spoken with have said that is the differentiating factor here for Netflix. That gives it the competitive edge, its exposure to international markets and the ability for Netflix to really create star-studded content that can really explode in overseas markets. So that's something to look out for moving forward. Another is live sports content. And we've seen a lot of competitors really go after these large contracts with the NBA, NHL, NFL. But Netflix is taking a slightly different approach here. They are leaning into docuseries like Full Swing, F1. They will reportedly be hosting a live celebrity golf tournament. And that just shows that they are trying to create franchises around sports. They're trying to create these characters that viewers can connect with. That is a cheaper option, and it also allows a lot more experimentation when it comes to the future of live sports, since that is really an untapped area for Netflix. So a lot of changes coming. Netflix also has gaming coming out too. So they're leaning into different types of areas of growth right now, and that's something to continue to watch for investors.
And certainly figuring out how they have to pivot given both the ongoing writer strike and the potential for a SAG-AFTRA strike, which means, obviously the international, not just exposure, the international play, they have to lean into that.
Right, and you think the longer this strike goes on, there's no end in sight right now, the more that's going to come into play. And because Netflix does have content creators all over the world, does have this access, that certainly is going to set them apart from competitors.
All right, we will have to put a pin in that. Ali Canal, thank you so much for that breakdown as usual. All right, coming up, after Federal Reserve Chair Jerome Powell's hints at more rate hikes, the S&P 500's check-boosted rally started to cool. Did the Fed completely kill the market's vibe, if you will, or will the growth continue? We've got a panel breaking it all down for you. That's next.
All right, well, stocks pulling back this week, heading for the worst week that we have seen in quite some time. Lots of worry just about what the Fed is going to do next, how high rates are going to climb in order for the Fed to get a better handle on inflation. So let's talk about what all this means for the markets, what it signals for the markets going forward. We have our all-star panel here for you guys to help break this all down. We have John Gagliardi, Fidelity Investments Vice President, Christina Hooper, Invesco Chief Global Market Strategist, and Thomas Hayes, Great Hill Capital Chairman. Great to have all three of you here. John, let me start with you just in terms of what we heard from Powell this week, once again messaging the fact that maybe 2 more rates are going to be needed. The market, though, ignoring that. What do you make just of the fact that that keeps happening time and time again, and what it signals?
So the Fed is a player in the market, and they're the biggest player, so they cannot be ignored. And it's normal, right? All of this is normal because the Fed is always in the markets. They've been around for 100 years. So all of this we got to take with, this is just the way it is. But the fact that markets are kind of chugging forward here, and I've been saying this for a couple of years, above 4,200, it really starts to get hard for the bears to make an argument that we're going down as we're going up. 3 higher highs, 3 higher, how many more higher highs and higher lows does it take for the bears to say, maybe the bulls have got it?
But is another rate hike, though, going to change that?
Well, I'm going to argue that there isn't going to be another rate hike. That what we're seeing, that dot plot is a paper tiger. Jay Powell is a paper tiger right now. He wants to keep a lid on financial conditions from easing. And so the way he's doing that is by releasing that dot plot and going on and continuing to say, we're going to hike rates more. But the reality is that the Fed doesn't want to hike rates more, that we're in a similar situation to where we were in May 2006, where Janet Yellen was telling them, don't hike anymore. We did it right in 94, 95. Don't keep going. But there is that interest in keeping that lid on financial conditions, not letting markets get ahead of themselves. That's what Jay Powell's doing. And in fact, he's achieved his goal this week because we have seen that pullback in markets.
Thomas, are you nodding your head there?
I agree with Christina 100%. They have to pin long-term inflation expectations to manage behavior. So they don't want people to expect prices to go up. They want people to expect inflation to come down. But I don't think they're going to raise because you have owner's equivalent rent now kicking in off a very high base effect. So that lags the deceleration in the increase in home prices by about 18 months. And we're going to get a big drop in July well before the live meeting. So I think the skip turns into another skip, turns into a pause. And if you look at 5-year inflation break-evens, they've been very successful with this targeting in a sense that 5-year break-evens are at 2.18%, back to levels we haven't seen since 2018. So they're being very successful with the hawkish talk and the dovish actions.
So it almost sounds like you guys are saying that the market's reaction, even to Powell's messaging this week, the fact that he is saying he's more hawkish rhetoric, yet looking past that seems to be what you guys think is the right response.
Absolutely. Well, that's going to help prevent another rate hike, right? That would really be the catalyst. I think of a few different triggers that could be the catalyst for another rate hike. One, of course, is the market getting ahead of itself. The other is if we did see a Michigan inflation expectations print that's higher than expected. Recall that that was one of the 2 triggers for the Fed to go from 50 basis points, as it had telegraphed, to 75 basis points in June of 2022. But beyond that, I think that we're moving in the right direction, and that finally markets are listening to Powell, even though I don't believe him.
What do you think it's going to tell us just in terms of the leadership here? Because so much of the conversation about the gains since the start of the year has been obviously concentrated by just over a handful of names within the tech sector. We have seen that market breadth broaden out just a bit. Not enough, I don't think, to get too excited about. But obviously, it's a step in the right direction, right?
You know, for me, I hate to sound like a broken record. By the way, Christine and Tom are awesome. I'm the only person here. I have no idea what Jay Powell and the Fed's going to do. And I don't
think any of us do. We all just like talking about it. We all like guessing. You know, it makes for good conversation.
What are you talking about? I brought in my crystal ball. Come on.
Every time they do something, it's always shocking. And the market's reaction is always kind of surprising as well. But this feels like more normal. The fact that we see the top 10 names in the S&P outperforming the S&P, it's LeBron James, it's Michael Jordan. They score the most points in the game. What would be really unusual if a person comes from the bench and outscores LeBron James? That would be weird. But in this case, we really have the leaders leading. And I know earlier this morning we had somebody talking about home builders as an analyst, and Home builders are leading. They're at all-time highs. So there are some of your secondary and tertiary players who are starting to lead. So as you said, it is broadening out, and sector rotation is the lifeblood of a bull market.
Tom, do you think we'll continue to see some of that rotation into names out of technology?
I think that's the trade for the second half of this year. So you've seen, up until about a month ago, the bottom 93% of the S&P 500 in aggregate had performed about 0% year to date. Moving forward, we see a scenario for the second half of the year. Maybe you have mid to high single digits more for the indices. I don't think the money is going to be made in the indices. I think the money is going to be made, the magic is going to happen underneath the surface, and those 90% are really going to benefit. And I think with the Fed getting out of the way, the dollar resuming that downtrend that it started in October could be monstrous for multinationals, specifically the ones that get more than 50% of their revenues from abroad. Emerging markets trade could start to get bids. Some of the higher risk groups like biotech could start to get some inflows. So there's a lot to do under the surface moving into year end.
Christina, do you agree with that, just in terms of the leadership that we could see?
I do think so. I mean, what we're seeing right now is pretty normal for this component of the market cycle, right? Markets are anticipating an economic downturn, and we tend to see a narrowing in leadership. But then once the pause really does feel like a pause to markets, that's when they're likely to start discounting that economic recovery, and that's when I think we'll see that rotation to smaller caps, to cyclicals, and that would signal a very different kind of market environment because of that expectation. So that is usually when we see much broader leadership and more participating.
John, how much of the excitement in the markets this year, and particularly what I'm talking about, is this hype around AI? There's been so much talk of the FOMO trade, people seeing how much so many of these stocks, some of these stocks I should say, have risen and they want to jump on board. Is the FOMO trade, is that still a thing? Or as we start to see broader participation, maybe that's going to be a conversation of the past?
It's the new story. So there's always three things that drives a stock forward, and Peter Lynch talked about this all the time. There's the story, there's the numbers, and then there's the chart. So when I look at this, I always think of, well, what's the current story? And the market needs, the story is like the lifeblood, right? Because if we stand around and look at balance sheets and charts all day, it's kind of a snooze fest because it's yesterday's newspaper. What's the future hold? And when you say AI, it is exciting, and you are going to need chips, and you are going to need tech. And we're seeing that same leadership that we saw coming out of COVID taking over again. It's so surprising. This year has been so confusing for investors. Remember the beginning of the year, we were all talking about industrials and healthcare. We were a stone's throw from all-time highs, and they took a back seat. All of a sudden, tech came roaring back with semis yet again, and it felt just like, here we go. It feels like 2021 regurgitated. And to be fair, like you said, it's the beginning of a new bull market cycle. It's usually financials, consumer discretion, and tech.
What about all the talk, though, outside of the U.S.? The more and more people that we've been having on recently talking about just the outperformance of the U.S. up until this point this year. And maybe it's time to start adding some exposure to internationals. Is that an opportunity, Tom, that you think makes sense, given the fact that I know you guys are very encouraged and very positive, maybe that the Fed isn't going to raise rates again, but what if they do?
Yeah, I think it's not an either or, it's a both and. So I think tech can continue to perform, but maybe on a relative basis underperform for some of these groups that are going to do well. So we have two kind of themes. Number one is the dollar-based theme. The dollar weakening is going to be very positive for emerging market inflows and international stock inflows. And they're just starting to break out global stocks ex-US relative to bonds, which has been in a sideways channel for 10, 11, 12 years. Now they're starting to take off. So I think that's going to be a monster outperform trade, not at the expense. It doesn't mean NVIDIA has to crash or Apple has to crash or Microsoft. It could just mean that those consolidate, they perform less well, and then you start to see more and more flows into emerging markets. And I think you've got the dollar trade, but you also have the interest rate trade, which is going to be reflected, as Christina said, in banks as their loan books get better, as their balance sheets get better, as their funding costs get quantified. And a group that no one loves, which is REITs, which is interest rate sensitive, could start to get a bid as well. But we love the emerging markets. We love the China trade moving forward, which is a little hairy right now, but I think you're going to see some positive things in the second half.
Christina, should investors be using a week like this week, where we did see some downward action in the market, should they be using dips like this to buy?
Absolutely. But just to key off the international conversation, they can't think just domestically. there are opportunities outside the U.S., and especially given that the dollar is likely to weaken as we go into the back half of this year, this is a time to be shopping selectively internationally. So some developed international, but also in particular, I'm excited about Asia EM. And part of it is that China reopening story, but you can play that with Chinese stocks or with some Asia EMs that are likely to benefit. We have to think about the China story as one in which they were closed for a lot longer than other major economies. That is a very coiled spring. And so this reopening has legs, and it's actually going to be helped along by what I think is going to be some significant stimulus from China, both monetary, we started to see that reduction in policy rates, but also some fiscal stimulus.
All right, guys, as we wrap this up, we're going to go around the horn real quick, and I'll give you two options. Either your top trade for the second half of the year or the number one data point that you will be watching that you think is so critical outside of inflation. We all know inflation is maybe the easy answer there. But what else are you watching? John, you first.
I focus so heavily on the S&P because that is the benchmark. That's what everyone is based on, and that's responsible for most of your returns. Market does well, we all do well. So I'm watching very closely to see how the S&P reacts, and as excited as we are now, like everybody planted their flag and said 20%, we are now in a new bull market. I think everyone's saying that just in time for the summer slowdown. So I'd like to see around August, what does the market look like then? If we pull back, there may be some opportunities in the future.
Christina?
Two, Asia EM, and I'm very excited right now about investment grade corporate bonds. We have to recognize this is a golden age of fixed income. We haven't talked about that, or we're pretty close to a golden age, after having gone through the pain of last year. Now that rates have risen significantly, there's an abundance of opportunities within fixed income. The one measure, the one metric I'm going to be most focused on, I mentioned this, Michigan consumer inflation expectations. I think it's critical. It's not technically inflation, but I think it's an important part of the Fed calculus.
Tom?
I think the biggest trade for relative outperformance for the second half is going to be emerging markets in China. I think the stimulus is going to be bigger than people expect, and I think it's not going to be a linear recovery when it actually kicks in and we see second quarter earnings. We just had the 618 holiday. We saw the retail sales up 14.8% for Alibaba. People are going to be surprised by that, and there's going to be a chase. Opinion follows trend. When price goes up, all the money's going to start to follow in. That's one, and I think the second laggard that I think is going to be a relative outperformance is going to be small caps, and regional banks is a major part of that story, and I think you're going to start to see those get bid in the second half, and we're pretty excited about that.
All right, guys, we got to leave it there. This is a great all-star panel to wrap up what has been a pretty eventful week here for the markets. Tom Hayes, Christina Hooper, and John Gagliardi, thanks so much for joining us here. That does it for us today on Yahoo Finance, but make sure you stick around 3 p.m. Eastern Time. We've got all your coverage leading up to and after the closing bell. We'll see you then.